again. Sorry, just trying to pick up on number 24. I misspoke that it is the case that when you calculate your interest, you have $5,000 at 9% for an entire year. It was taken out in 15. We're talking about the 16 end of the year. So we have a whole year worth of interest. So there will be 2 years of interest. That's going to be broken out between year 15, 16, which is this year, and then the remainder in 17. There was a typo on the exam. It said 18, and this should have been 17. So because of that, I gave everyone credit back for that. But the correct answer was $450. Sorry for that misspeaking a little bit earlier. But your interest payable is the $450. Interest expense, again, is the $450. On this question, I had some students who were getting a little bit confused about when you could tell if the numbers on a trial balance were adjusted or unadjusted. And the bottom line here is when you have information in expenses similar to supplies expense, interest expense, you also have salaries payable. These are all clues that this information has been adjusted and you can prepare financials. Why? Supplies are not expensed until they're used, and we don't expense them until the end of the year or when we make financial statements. So they're made through an adjustment. The expense is done through an adjustment. So if you see an expense, you can assume it's been adjusted. Likewise, if you see interest expense, again, we don't book interest expense until the end of the year or when we make financials, and it's made through an adjustment. When you see salaries payable, we normally don't accrue salaries on a daily basis. The only time we're going to accrue salaries is at the end of the year or when we make financials to book the actual wage expense and match it to the revenue in the year that it happened. So the only time we're going to pick up a payable for salaries is when we make an accrual and an adjustment at the end of the year, since we haven't paid cash yet. So those would be the big clues that would say that you could assume that this has been adjusted. It's normally based on expenses. Prepaid rent, usually we're used to seeing prepaid, but we don't see a prepaid up here. Most likely it's because it's been used up for the end of the year and there was no balance to carry on. So I just wanted to point that out in case students had questions on that one. And the last one I gave full credit to just because a lot of students, some students didn't get this right, and it was more for me just to see how you guys were doing. But in Chapter 2, we talked about recognizing revenues or expenses versus realization. And again, that's based on accruals. So when is the revenue from a sale of merchandise normally recorded? The minute that you make that sale. The next one was when the customer pays. That would be cash accounting. At the earlier of the two dates, that's not correct. It's the date of sale. When the merchandise is sold, if sold for cash, again, this is talking about cash accounting. That's not true. Or when payment is received, is sold on credit. No. If it's sold on credit, we book that entry right away and we have an account receivable. So those were the issues that I saw for this test and just wanted to go over them. Please post any questions that you might have in the test 1 or just test folder under discussions. I hope that helped everybody. Thank you.